Good morning, everyone. Certified Kingdom Advisor Mark Trice with Clear Vista Financial. Today is our monthly market update for, well, it's September, a couple of days after Labor Day. Hope you had a wonderful holiday. I appreciate you taking some time to join us today. This one is going to be a little bit shorter than normal, simply because there is so much important economic data that's coming out within the next couple of weeks. And so we're going to share some things, but we're going to hold some things till next month if we can. So let's go ahead and jump in. All right. So we're going to talk about how the markets did this last month. It was an unusual August. And we'll talk about what's going on now. I'll give you a brief economic update because there have been a few announcements that are important. And as always, we'll talk about why this is important. Forgive the laser that's on the screen. I will be talking about that, using it in just a moment. Okay, here's how the indexes did during the month of August. S&P 500 was up 1.91%. The NASDAQ up 1.58%. Now these had during the month actually set up new highs, and they pulled back subsequently since then. But we did reach new highs and pulled back from those things. But this is a good sign because usually August is one of those months that's really volatile. I know in the last several years, the month of August has been a typical sell-off. It was great we didn't have that this year. We are going into the worst performing month of the year historically, the month of September. And to top it off, there's a lot of economic information that will impact markets coming out in the coming weeks. The Russell 2000, wow, it really did really well, up 7.19%. Long-term treasuries continue their decline. Yields are continuing to rise there, keeping the price of those bonds down lower and heading lower. In the last week, since the end of the month, we have seen bonds continue to sell off. We'll have to see if that continues once the Fed meets. The moderate index, which we kind of use as a benchmark, was up 1.72% for the month of August. Now let's look at a couple of charts. I don't have a bunch of charts this month, but I wanted to look at the Russell 2000. So the blue line up here is really the high all the way back from 2021. We reached that during the earlier part of the year, and then we sold off in July, and we recovered in August. We haven't quite hit that mark yet again, so we've recovered, but it didn't hold, and we're hoping that we'll recover and break through to new highs some point in the year. Now, this red line that I have here, that represents in the month of June, July, that was about a 30% sell-off in the Russell 2000. How about the moderate index? This is one we measure again, going all the way back to 2021 was the previous high. And of course, we had 2022. We spent several years, a couple of years moving sideways. We started to recover in 24, sold off in early 25, and now we have broken to new highs. That's a positive sign for the broader markets. Of course, here's our disclosures. Please take a moment to read. There will be a quiz at the end of the program today, so I expect you to know what these indexes mean. Just teasing. Don't log off. Will be no quiz, I promise. Okay, let's move on. Let's talk about volatility. I said that typically the month of September is the worst performing month historically. In the last 18 years, the month of September has ended the month down 14 times. Hopefully this won't be number 15, but earlier in the month so far, just a few days into September, the markets are down just a little bit, but we'll see if that recovers and comes up. I think a lot of it's going to depend upon the economic update and the data that's coming out in the next few weeks. Let's jump into that though. But remember, send your text, your questions to 254-282-0495. I'd love to talk to you on the program today. Moving forward here. Okay. Let's talk about the Fed. The Fed met in July, at the end of July, and they made the decision to hold rates steady. Now, the interesting thing that happened this time was that there were two regional Fed chairmen that voted against. They were dissenting against the overall opinion to hold rates steady. They thought that those two thought that we should start lowering rates. And then a couple of days later, there was data that came out. Employment had cooled quite a bit in July. And recently, at the G7 meeting in Montana, Chairman Powell gave a speech that basically said that he was open to cutting rates in September, that in fact the economy had cooled enough with employment, because they have a dual mandate: keep inflation low and keep employment going, unemployment low as well. And so given those two mandates that they have, he kind of made the announcement that rate cuts are on the table. So they meet next week, I think, or week after next, September 16th and 17th. We will see if they cut rates. We could be seeing, I think, maybe the markets are pricing in about 1/4 point. Now, this is not going to cause the markets to just react and explode. The markets have already baked in these rate cuts. So you're not going to see a huge run up in the market. Now, a couple of things that are play here. The chair is going to be replaced. Powell's term as chair will expire, I think, in May. And of course, if you read the news, Trump's trying to get rid of him earlier than that. This is supposed to be a quasi-independent body, and the president really can influence things, but he can't make the decisions as far as I'm concerned. There are some structural risks there. We've got this huge balance sheet on the for the federal government. We have $37 trillion in debt, and the approach to interest rates can affect the refinancing of that. And in fact, if we have a new Fed chair come next May, that could really shape the approach to monetary policy that the Fed oversees. The Treasury curve, it is inverted again, and that's great. This is a more normal curve, although we normally see the shorter term rates lower than the 10-year and other things like that. So those have yet to come down. That's why you can still get a 4% CD at your bank or credit union. And so we're, seeing that continue to stay a little bit higher on the end. And of course, 30-year mortgage rates have risen back up to the levels that they normally would see there. Okay. Let's talk about the Consumer Price Index. The CPI rose 0.2% in July. That was within expectations. That's a 2.7% year over year. Now, folks, a lot of the media tends to focus on the year over year number to say, oh, inflation's rising. And the reality is inflation has been lower. What we remember back in last July, inflation was 0. And so any movement in the positive direction is going to make it seem like overall inflation is high, when in reality it's really been maintained and coming down slightly. Are tariffs going to cause inflation to rise? It's still too early to tell. If you listened to our program last month, you know that it's way too early for us to determine those things. And really, tariffs can raise prices for specific items, but don't generally drive a broad inflation. Monetary policy is really the key driver there for inflation. And the reason that we had a lot of inflation, we were printing lots of money and we were trying to keep interest rates super, super cheap over the last decade. And that was one of the causes of inflation. The super core inflation, which throws out some of the more volatile stuff, That is 1.9% annualized over the past 6 months. And that right there really supports a case for the Federal Reserve cutting rates here in a couple weeks. So we're still seeing that monetary tightness. The M2 money supply has been slowing very much so. And I think we'll probably see a slight, maybe quarter point rate cut in September. We also look at the producer price index. This is a little bit thing here. Now, this went up quite a bit. And that was expectations were for it to rise similar to the consumer price index, but it rose 0.9%. Now that core there, same rise there, 3.7% year over year. That's a little concerning, but there's a lot of dynamics going on here when it comes to inflation and the producer price index. There's a lot of building up of inventories in the early part of the year prior to the Trump tariff announcements, because people were anticipating that. So we just have to continue to watch this. Hiring slowed quite a bit in July, but unemployment claims stayed low as well. So not sure how to interpret that just yet. As far as the growth in the economy, the real GDP was revised up to 3.3%. We expected to have a 3.1% annualized growth rate. They went back and revised the first quarter as well. So that's a positive, showing some strength. So you've got several things. You got some things that are showing weakness. You've got some things that are showing the economy is strong. We do think that stocks are still a little bit overvalued. One of the fund groups we use, their economists have a model that they use, and they suggest that stocks still are a little bit overvalued. So should we see a correction come this September, I would not be surprised. Doesn't mean we try to predict, but it does mean that, we're not surprised when something happens, given the fact that stocks are still a little bit overpriced relative to what they are now. If they change interest rates, that can make them more in line with what their true value should be. Okay, existing home sales up 2% to an annualized rate of 4.01 million homes. That beat the expected 3.92 year over year. That's up 0.8% in July. That's good. The best performing regions were the Northeast, the South, and the Midwest. These are existing home sales. The median price home is down in July, but still up slightly year over year of 0.2%. Let's see here. Go at new home sales. Those fell. Now, that could be a number of different factors. That qualifying for new homes, loans could be a little bit harder. There could be a slowdown in construction starts. It's still going to be an issue that's going to help work itself out. The month supply of new homes is still steady at 9.2 months. Now, this is, being a former realtor, I understand this. This is how long a typical new home stays on the market before it sells. And so that's kind of interesting to see that it's that far out. You might remember, especially if you live in a market like Austin or Dallas, you might remember the time when houses on the market would not stay on the market for more than 30 days. The inventory was exceedingly low. We're seeing a greater supply now because they're selling slower and they're also less affordable. And the affordability issue is going to be the real issue that I think we'll begin to see some policies come out of Washington to address that. We've already talked about new home sales, but the housing starts, those were up. And so I just contradicted myself, but those are up in July, and that's a positive, showing another positive sign. However, building permits, future expectations were down 2.8%. So a mixed bag of information here. Okay, let's jump right into the impact and solutions. If you do not have an advisor, make sure you're talking to one. If you don't have one and you'd like to talk to us, please give us a call. You can send us an email or that text 254-282-0495. Say hello, introduce us, say you like an appointment. But remember, folks, no matter what happens with the markets, no matter what happens with policy, don't panic. You want to avoid those decisions based on headlines. And it's so crazy. I love reading headlines when I don't have to interpret them, because you can look at one magazine or one paper and it'll have a headline of gloom and doom. And then the next headline, same story, same data. It's all things are rosy. So it just kind of depends on where you're getting your news sources. But don't panic. Don't make decisions based on headlines. But you do want to make sure you're staying informed and ahead of things. What about your 401k? A lot of people are still unaware that their 401k may be underperforming relative to the overall markets. And that could be, a lot of people are in life cycle funds or target date funds, as they're sometimes called, and they're holding a lot of bonds, which tend to be dragging down that performance. Give us a call, send us a text. We can show you how to look at your 401k. And that's a service that's available to you. We'll help you with rebalancing that from time to time and navigate those things. If you're over the age of 59 and a half, maybe you want to consider other options that are out there, but talk to your advisor, because we do have some great tools available for helping you manage your 401k at your workplace. Okay. Let's see here. Always check your statements. Let's look and see if there are questions on the board. Okay, here's one. The question has to do with manufacturing and Trump saying that the tariffs were going to bring manufacturing jobs back to America. And that in some ways might happen, or it might not. The thing we have to remember, now we all remember the 80s and the 90s, manufacturing jobs seemed to be leaving the United States. And in fact, many companies in America chose to open factories overseas. So that was true. At the same time, we also saw a dramatic increase in manufacturing productivity. Automation, technology, and things allowed us to produce better and better quality goods for lower prices with less people, because we're taking that technology and completing it and making it into a very productive process. So you had a double whammy during those times in the 90s and early 2000s, where you had companies moving their factories overseas and increased productivity, which meant that labor employment in manufacturing was going down quite a bit. I think that some of the tariffs will cause, and we've already heard announcements of other investments from companies investing in the U.S., even foreign companies investing in the U.S. Those are all positive things that will result in jobs, but I don't think it's going to be this renaissance of manufacturing renewal and thousands of jobs. I think if we as Americans need to be constantly in a learning mode, upgrading our job skills so that we can stay relevant as technology and productivity changes. Be relevant, keep working, keep improving your skills so that no matter what happens with manufacturing or the service sector, that you are, in fact, not immune from it, but prepared to adapt. Okay, I don't see any other calls on the board. I said this would be a little bit shorter today, but so I appreciate that. We'll be having a much more extensive October version of this. We may even have some things coming out in the interim talking about some of the changes that are taking place. You can always give us a call at 800-491-4580 and or send us a text at 254-282-0495. Visit us on the web. We have lots of good articles and resources, YouTube videos from our podcast, The Spend Life Well Show. And gosh, we're up over almost 200 videos now that you can watch, and they're all pretty short. But if you need to schedule an appointment with your client, you can always go to calendly.com/Mark Trice and select that, and we can get in touch with you and get you in our office or on the phone. But as always, we appreciate each and every one of you that took a time to listen today. And I want to thank you for watching our podcast or our video here. of the monthly market update, Clear Vista Financial Perspectives. Until next time, folks, have a great week. Thanks so much.
Securities offered through Cambridge Investment Research Incorporated, a broker-dealer, member FINRA SIPC. Advisory services through Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Cambridge and Clear Vista Financial are not affiliated. Discussions in the show should not be construed as recommendations or investment advice. Always consult with your investment professional before making important investment decisions.